Hello, welcome to Rational Investing. My name is Cameron Stewart CFA. Thank you very much for watching the channel and all the support. I greatly appreciate the subscribers and the comments, and of course the suggestions for what to look next. One suggestion I got was Sony, and I dug into it and really liked what I read. Wanted to do this episode on Sony. But before we dive into this, I want to cover the 5 key attributes that we use at this channel for rational investors and how we determine what a company is and how to pay for it. The first one being top line revenue growth. Must have top line revenue growth. Second is EBITDA growth. The third is strong cash flow. The fourth is we want low debt. We measure that by less than 3 times debt to EBITDA. And finally, we want a well-priced security. That would be one that is trading a relatively low multiple of enterprise value to EBITDA, either low or a fair value. We just don't want to pay too much for the cash flow. Please reference my Domino's versus Google video where I showed the IPO performance since the IPO of both those companies 15 years ago, and how Domino's beats Google because you could have bought it so cheaply when it IPO'd. Really fascinating lesson. I really appreciate that. Okay, that's the rules. Let's dive right into Sony and go through it. Here is their corporate report. It's high gloss, it's color. Let's go through this a little bit for some background. I'm going to point out a couple key things that I really liked. Number one, let's go through and look at Longterm Vision, page 13. Look at this. This gives you 1980, 1990, 2000, 2010, and 2019 as a view of a portfolio for where they derive their revenue from. And if that's not long-term thinking, I don't know what is. And kudos for them for putting it out there. But it really shows you how their portfolio has morphed from it essentially entirely electronics to a basket of services that includes a financial institution, banking, Sony Financial, which does primarily life insurance, auto insurance, but has banking services, takes deposits, takes premiums in. So it really complicated the cash flow statement. I'll show you later, and I had to make some general assumptions to try to value the business primarily off its consumer products goods, simply because it was so complex trying to both value a bank and a consumer products company. How do you do that? I set the financial institution aside, and you'll see financial services 16% of top line revenue. So it's not a huge assumption that I set that aside for simplicity's sake, but I'll show you how I did that later on. Gaming has grown substantially. Gaming is now 24% of total revenue. You can see games were only 12. And then prior to that, I think it was 9% back in 2020. So gaming is definitely growing. That's going to bode well for the launch of the PS5 coming out. Couple comments on the PS5, or at least the gaming aspect. They have they've sold 100 million PS4s. That's an incredible number, and I love just how kind of curly that number is. So they're going to do, I would imagine, that if not more for the PS5. They have 45 million subscribers. Kudos to them. I hear subscriber, I think recurring revenue. I hear recurring revenue, I think high multiple. This is looking good. So I liked that. The other big thing I want to point out is the electronics. Electronics has gone from 49%. I'm adding up the sound area and then the mobile and the devices to get the electronics equivalent. They kind of stopped breaking it out. And then from there, they break it out again in 2019 here at 24%. So the electronics division is dropped considerably over this period of time. And you're going to see that in their both top line revenue and their margins. I think it's a fascinating study of how they've migrated into a higher profit margin business. But I'm getting ahead of myself. You want to see the numbers. I'm rambling. Let's keep moving, okay? What else is cool of this report? Let's go back and I'll show you a couple more things. One, really liked how they broke out operating cash flow right there in the deck, and they showed you operating cash flow by segment, which corresponds to previous segments. And you can see the top segments, gaming. This drop here, 330 billion yen, by the way, billion yen, 334 versus 180 billion yen in the most current year. I think that drop is probably just people waiting for the PS5, so that should spike back up. And the next big thing is the imaging and sensoring solution. They think this is a really big bet. All their CapEx really predominantly going into this region. But then you've got music, which is up, pictures, which is up year over year, and electronics, which is continuing this slow decline. So their basket is doing well, but for the electronics, which is kind of a slow grade on margin, but I really liked how they broke that out. Then if you just keep reading, it gives summary and really good detail on every single division, which is fantastic. The only reference to kind of return on capital I did see is they said that in the imaging sector, they're getting plus 20% ROIC, return on invested capital, which is a really nice curly number. But they didn't give the same metric for all the divisions. And they also said that they're really not investing much at all in the electronics division. They're just basically maintenance CapEx. They're pushing hard on obviously in gaming, and then obviously in the imaging, and sensory, which is where they're going with their AI and with the automotive industry. So really interesting. Enough about that. Let's go dive into the numbers and see what we got. That's what you came here for. Let's go dig into the financials. The 10K, or rather in this case, the 20F, is all in yen. And it's quite a lot of yen. It's in billions of yen. I'll just run through it quickly. So Sony Corporation consolidated statement of income, right? I'm on page 128 from their 20F, and you can see top line sales. That is these are million yen, so that's 7.23 trillion yen, which is very confusing. What do you do with that? So this is how you convert foreign currencies into USD on a financial basis. So again, income statement and balance sheet get the average for the fiscal year on the FX rate, and the balance sheet, because the balance sheet is a point in time, it gets that point in time's exchange rate. All right, here we go. Let's dive right in. Revenue, what do we got? So this is billions of USD, 2012 to 2020. Again, that's March 31st ending 2020. $74.5 billion. Up top, $75.4 billion. That is a cool zero growth rate, which was alarming and shocking to me. I expected a whole lot more, honestly. Reading through this material, I thought they were going to crush it with the PS5 coming out and the PS4 before that. I'm like, these guys are going to be a smoke show. It's going to be great. What happened? The only thing I can think here is that they've got a giant division, which is their electronics division, that's slowly being transitioned into a diverse portfolio. And I think that's just because the margins in TVs aren't there. The TVs are coming down in price, and that's lower revenue. That's my assumption here. Feel free to add comments below. Check me on that. But my gut is saying that going from essentially 70% electronics to what I say 24% last fiscal year, that decline in revenue is probably price, less so volume, because there's still a dominant player, but it could be volume. As a result, that downward pressure on price or revenue is what's holding this revenue back. I think that's it. And then you're seeing them dive into other businesses to grow, both subscription and non, but to grow. And that is very interesting. Check this out. Revenue flat at zero. EBITDA $4 billion to $10.6 billion. Heyo, that is big. That's a doubling of EBITDA, or 12% annualized growth rate on flat revenue. That is impressive. In fact, it's another slide I didn't get to show you on this deck had I kept going right here. So this is essentially summarizing what I just told you. This is revenue on this side. Again, I'm back in billions of yen because it's their deck. Essentially flat. And then operating income margin, so OI margin, operating income divided by sales gets you this, and you can see fat margin expansion towards the last 3 fiscal years, kind of stabilized around that 10% range, where before it was small to say the least. So I think that is them expanding into different subscription models. It's expanding them into different higher margin products. that you already saw. See, was there anything else on this deck while I'm here? Oh yeah, the last thing, return on equity, which I thought was nice, kind of jumps here, corresponding with the higher margin. But let's get back to the financials. So EBITDA margin grown steadily. So this definitely checks the EBITDA box. Revenue for me was not checked. I'll give it the 0, especially with inflation coming. That's my assumption. But having a 0 growth is a problem. What I think is going to happen going forward, though, is I think going forward you're going to see the TV and electronics kind of bottom out. Now it's a smaller piece of the portfolio as a whole. If that does decline, it has a smaller impact on the numbers, while other divisions can be invested and can grow. So I actually kind of quite like this. Because we value companies on earnings, that's what we want to see. Debt, very small, essentially flat to slight decline over that 9-year period of time. Phenomenal. Market cap, 17 billion to 80 billion. You add these up and you get enterprise value. One note on cash, they do have marketable securities in their on their balance sheet, but I have chosen not to include those because those market securities belong to some of the financial customers that have deposited money with them. So that's not actually cash that they could distribute, and I didn't want to include that in the enterprise value and kind of convolute things. So I just left it off. There is cash, there's plenty of cash in that balance sheet, but I can't just differentiate cash on deposit with cash that's operating cash, so I chose to exclude it all to be safe. Enterprise value, 30 billion to 90 billion. That's a 3 times fold growth on the enterprise value, on a doubling 2.5 times on the EBITDA. So I would expect a little bit of margin expansion on the enterprise value to multiple, and you do get that. 7 times, 5 times by the way. Look at this. Look how cheap this is. 5 times, 6 times enterprise value to EBITDA for a company the size of Sony. Definitely being written off the last several years. You had to hang on to it for a while to really get there, but it's 8.5 to 9 times EBITDA. Still remarkably cheap currently. The last thing we check is debt. Debt here, it's gone from 3x EBITDA to 1 times EBITDA. That definitely checks our box for low debt, right? We look for less than 3 times debt to EBITDA ratio as our smell check against bankruptcy. Here, they're 1 times levered, which is fantastic. And I love to see that, especially because they have cash in the balance sheet that I haven't even included. Back on the pricing multiple, this to me seems fair or cheap, leaning on the cheap side. So I think if I were to recap quickly, revenue is flat, earnings are growing, the company seems well priced to me, and low debt. Let's go look at cash flow and see where we get. These yield numbers are extremely high. And when I looked at it, it just didn't smell right to me. I know it's cheap, but a 26% yielding stock, that doesn't make much sense to me. 15, 12, what's going on here? So I looked at this, and I want to show you on the actual cash flow statement. So I'm going to go to the statement of cash flows. So you can see the top, Sony Corporation consolidated statement of cash flows. First third, right, is operating cash flow. That's what I've pulled at the CFO level, converted to dollars. 2020 is this long column here, the far end. Here's your cash flow from operations, 1.3 trillion yen. I use that here, 1.3 trillion yen, and then convert that to dollars, and I get $12 billion. So that's how I'm converting it. But where I came into problems with the cash flow statement, it's below that line. It's right here. Payments for investments and advances by financial services business. $1.3 trillion. This smokes all the free cash flow. So when I converted this to dollars and I looked at this large free cash flow that I had here of 7.5 billion, I'm back in dollars now, that was yen, dollars. That 1.3 trillion converted to dollars basically removes this. And looking through the statement, there are a number of other items that references future insurance policies. 520 billion yen. That's a massive amount of inflow. And so as a result, I got hung up, and it took me quite a while to finally say, you know what, I need to separate the financial institution because it's roughly 16%, I think I said, yeah, 16% of revenue. I'm going to set it aside and just look at the financials from a consumer products perspective and value the cash flow on that with a little extra for the financial services. So thankfully, Sony actually breaks out the financials and says, this is Sony just financial services, and this is consolidated. Let's go take a look at that, and I think that's going to answer a lot of our questions. So financial services, Sony without financial services, and then finally on the other end, consolidated together. So what I've done is I've gone through, and for just 2020, I said let's just pull the cash flow from operations from the Sony Corporation without financial services. So just this bold column here, I'm going to pick up my cash flow from operations from the non-financial services. So what does that include? That includes the imaging and sensory. That includes gaming. That includes music. That includes pictures and the electronics piece. So it's 84% of their business is represented in this column. So that's 762 billion yen is the CFO. CapEx, 420 billion yen. And then I've got some net borrowings here. And then this is the dividend. Dividend is 50 billion yen. And the stock buyback, they buy back a lot of stock, 250 billion yen. So what I did is I did all that, and then I said, well, how much cash does the financial services actually make? And just add that cash, the net cash, to this number. And what I did is I pulled this line here, net increase in cash, cash equivalents, that 40 billion yen. That's essentially the net cash increase after it's all said and done within the financial institution. I add that to the CFO of the operating segment to get these numbers, and I'll show you them right now. So here it is. Converted into dollars, the 2020 CFO plus the CFO for just the Sony Corporation plus the net cash of the financial services, $7.2 billion. Less the CapEx for just the Sony Enterprise leaves me, and the debt payment leaves me $2.7 billion of free cash flow from the Sony Corporation with a little sprinkle of free cash from the financial institution. And I smell check this against what the dividends they paid out and the stock buyback. Remember I showed that last little piece? Well, they bought back and they paid out a dividend. The cash money they paid out was $456 million and $1.6 billion of buyback for a total cash out of $2.3 billion. That smell checks quite nicely with this $2.7 billion of total free cash. So they did pay out a lot of cash that they did generate. But I think those two numbers kind of tie. Divide by the shares outstanding gives me a cash flow per share of $2.27. And I'm going to use that number to forecast forward. Because up here, this $6.20 has cash in it that really they put it back into the financial institution, or it could be deposits that people gave and they're confusing it in the CFO area. So I said, forget it, put it off aside. And that's a yield of 3.4%. Okay, that's the actuals. Let's review quickly. Revenue flat, earnings growing. We've got debt, which is zero, well-priced, and strong free cash flow. I'm going to give them the free cash flow. It is strong, despite this last 5 minutes they just went through it. Now let's forecast forward and see what we get. So I'm going to give a 6% growth rate to the EBITDA, and I'll explain why. I had 12% here earlier, yes, but if you look here, it's 57% increase, which is skewing this number. So I'm taking kind of these numbers here, looking at this area in here, and kind of averaging out and saying they're going to grow at about 6% rate growing forward, given that the electronics is kind of bottoming with 24%, and the other 75-ish% of revenue should continue to grow. So I gave them a 6 handle on the growth rate. That takes EBITDA from roughly 11 to 19 billion US dollars in 10 years. If I give it a 11 times EBITDA market multiple, which is slightly higher than the 9 times they're currently receiving, but I think they deserve it. They're moving into a higher margin business. They need more recognition. They haven't received it. Recently they have, but I think they could definitely get 11 times for the company. Less a little bit of debt gives me a market cap. Shares outstanding still remaining 1.2 billion. I divide the two and I get $140 for a stock price, 10-year estimate out in the future. The next one, let's go look at free cash flow and value the company on free cash flow. So again, picking up on the cash flow from just Sony Corporation without financial services and adding the net cash of the financial service at the very end, I get $2.41. That grows to $4. I added a 3% free cash flow yield on that money, and I get a $135 price target. So now we have two different methods to value Sony. We've got a market multiple EBITDA base, and we've got a free cash flow base. Let's put this into an IRR and see what we get. So it's currently trading at $72. We've got two different metrics, and we're going to average the two for $139 long-term price target. If I buy the company right now at $72, and over time I get this string of dividends, share buyback, what have you, we're assuming no share change at the end, so this is essentially assuming it's all dividend to you out, even though they could just as easily buy back shares, in which case this long-term target would be higher because there's fewer shares in the future outstanding that we did not assume. So this is just distributed out to you. Long-term price target. This series of cash flow produces an IRR of 11% annual. So that is an annual return of 11% over that decade's time, which is a very robust number. It is slightly above the historical financial market in the United States that has returned a roughly 10%. So 11% is a very decent return for a company that is both well diversified, low debt, is inexpensively priced, and the 11 times handle that I gave the ending value of the business is actually still fairly cheap. If they were to really grow both the service, the music business, the Sony Pictures, and the gaming, do all that on a subscription basis and have that recurring revenue, you could see that market multiple go to 15, 18, 20 times if it became really, really dominant, which obviously would magnify these returns quite exponentially, actually. So I think the upside here is high despite this kind of modest forecast. That gives you a 2.3 times your money. Let's look at a range and distribution. What happens if over time you're looking, some news article pops up, Sony, blah, blah, blah. You're like, oh, what's the value of the company? Well, you come back to this video, take a look. If this price has moved, it's currently $72. Let's say it's $96 or $90 in the future. You're looking over here. You think, wow, that's kind of like an 8 to 7% IRR, assuming the economic forecast here stays the same. But if the price should fall for some reason in and around the below 60 mark, you're looking at solid double-digit IRRs for over a decade. So that's actually extremely attractive from an investment perspective. So us at this channel, we're going to give it a good. I like the business. I certainly like how long-term the management team looks at it. Let's recap all 5 of our metrics. So top line revenue growth is flat, does not check the box. EBITDA, strong, it checks. Cash flow, strong, yes. Low debt, absolutely. And it is well priced. It's well priced or cheap in my opinion. So I think of the 4 out of 5, it does meet it. And I'm gonna give the revenue a pass because I think it's gonna grow going forward. I hope you liked the presentation of Sony. These are my assumptions on the economic return. Love to hear your thoughts and comments. Let me know if I missed anything. I'm happy to take questions. My name is Cameron Stewart, CFA. Thank you very much for watching Rational Investing. Please subscribe to the channel if you like the content and give me a comment on what you want to see next. Thank you very much. Bye-bye.